What's up in the world of private market investments? There was a survey by Goldman Sachs in September 2023 done on 200 LPs and GPs. An LP, which stands for limited partner, is an investor who provides capital to a fund but isn't really involved with fund management, so they are said to have limited liability. A GP, which stands for general partner, is an active manager of a fund responsible for managing, sourcing, and exiting investments on behalf of a fund's LPs. A GP typically contributes their own capital to the fund, making investment decisions, engaging in due diligence, and providing strategic guidance to portfolio companies. The Goldman Sachs survey unveiled that despite the global backdrop of economic uncertainty and geopolitical tensions, about 65% of respondents reported improved investment conditions in 2023 compared to a year ago. An additional 22% believe conditions are stabilizing. There is said to be over-allocation echoing through the industry. Over-allocation is a situation where the fund has committed and invested more capital than originally intended or allocated for a particular investment strategy or asset class. This could occur when the fund allocates a larger portion of its capital to a specific investment category, such as buyouts or VC, than initially planned. This could lead to a higher concentration of risk in a particular area and may not align with the fund's diversification goals. It could also result in limited resources available for other investment opportunities, potentially impacting the fund's overall performance and portfolio balance. According to the survey, despite over-allocation concerns, a higher share of LPs surveyed find themselves under-allocated to alternative investments. This shift suggests that LPs may be willing to explore new avenues even as they grapple with allocation concerns. For GPs, fundraising may have emerged as the top non-investment challenge. It is said to have grown more formidable in recent times, making it increasingly challenging for new GPs to establish a foothold in the market. Investors may be becoming more cautious and may be taking longer to decide whether they want to invest money into PE funds. Nearly 70% of these GPs are trying to gather money from investors or are planning to do so in 2024, and LPs are said to be looking at track record as the primary factor when evaluating GPs, which would create an uphill battle for newcomers. And what are the perceived risks in the investment landscape? They are said to center around macroeconomic concerns rather than market-specific factors. These include economic recession, geopolitical conflict, inflation, and interest rates. So, there may be a broader apprehension about the state of the global economy. And what about recessionary fears? About 80% of respondents expect a US recession within the next 2 years, with close to 25% seeing it coming by the end of 2023 and close to 55% seeing it coming in 2024. And about 90% anticipate a recession in EU countries. Close to 45% see it by the end of 2023 and a similar percentage see it by 2024. What about interest rates? In the US, close to 50% expect higher rates while about 45% anticipate rates remaining flat. Globally, the views are said to be reversed, with about 50% expecting flat rates by the end of the year and about 40% expecting higher rates. That being said, despite rising inflation and recessionary fears, LPs are said to remain resolute in their commitment to private markets. They are said to recall the lessons of the past and are determined not to repeat the mistakes made during previous economic downturns where they pulled back from alternatives. Instead of retreating, they are said to plan to navigate through these challenges with strong active management. And where are LPs allocating investments? The top 5 are buyouts, private credit, real estate, infrastructure, and growth. Private credit involves lending money to people, businesses, or other entities directly rather than through traditional financial institutions like banks. Infrastructure includes stuff like transport, energy, and utilities and are considered long-term and essential assets that provide basic services and support economic activities. Growth equity investments are made in companies that are expected to experience substantial growth in revenue and profitability. Unlike traditional private equity, which often involves taking a controlling stake in mature companies, Growth equity investors usually take minority stakes in companies that are in the expansion phase, and co-investments, opportunistic or distressed, and infrastructure are considered the most underallocated areas by LPs. Co-investments are opportunities where LPs invest directly alongside a PE in a specific deal or company. This would allow LPs to participate directly in a particular investment along the fund without going through the fund structure. And LPs recognize the need to establish deeper relationships with a select group of GPs. Sustainability is said to be a focus for about 75% of investors. Yet, the survey seems to reveal disparities in progress. While close to 45% of GPs report meaningful progress towards sustainable investment goals, only close to 20% of LPs share this sentiment. There's said to be a growing emphasis on renewable energy investments from about 20% of respondents. And over the next 5 years, AI and data science are expected by close to 35% of respondents to be the greatest drivers of alternative investment evolution. So, the private market landscape may be poised for change. There are said to be challenges like finding operational capacity, building resilient team cultures, retaining talent, and recruiting new talent. But in a world filled with uncertainty, the private market community is seen as remaining resilient. What is the future of private equity?